Hello students of grade 10, my name is Miss Neja Bamfield and I will be your tutor for today. Our lesson focus is productivity of labor, supply of human resources, and development. Picking up from our last session, I will go deeper into what productivity is all about. At the end of this lesson, your lesson objectives are to explain the importance of productivity in the areas of efficiency of labor, value and importance, factors affecting its supply, and human resource development. Definition of productivity. Productivity in economics measures output per unit of input, such as labor, capital, or any other resource, and is typically calculated for the economy as a whole as a ratio of gross domestic product, also known as the GDP, to hours work. What exactly is productivity? Labor productivity may be further broken down by sector to examine trends in labor growth, wage levels, and technological improvements. Corporate profits and shareholder returns are directly linked to productivity growth. At the corporate level, where productivity is a measure of the efficiency of a company's production process, it is calculated by measuring the number of units produced relative to the employee labor hours, or by measuring a company's net sales relative to employee labor hours. Understanding productivity. Productivity is the key source of economic growth and competitiveness. A country's ability to improve its standard of living depends almost entirely on its ability to raise its output per worker. That is, producing more goods and services for a given number of hours work. Economists use productivity growth to model the productive capacity of economies and determine their capacity utilization rates. This, in turn, is used to forecast business cycle and predict further levels of GDP growth. In addition, production capacity and utilization are used to assess demand and inflationary pressures. Labor productivity. The most commonly reported productivity measure is labor productivity, published by the Bureau of Labor Statistics. This is based on the ratio of GDP to the total hours work in the economy. Labor productivity growth comes from increases in the amount of capital available to each worker. That is, capital deepening. The education and experience of workforce, that is labor composition, and the improvements in technology, that is multi-factor productivity growth. Question. Productivity is an indicator of the health of an economy at a given point of time. True or false? If you said false, that is correct. Productivity is not an indicator of the health of an economy at a given point of time. Here is why. If output of hours worked are both falling while productivity is growing? Because hours worked might be falling faster than output, and because gains in productivity can occur both in recession and in expansion. That is why. One must take the economic context into account to analyze the productivity data. Overhead expenses, number of employees, production costs, hours invested, all have money value. Productivity in its broadest sense, as it relates to efficiency of labor, value of importance, factors affecting its supply, human resource development. Let us dive deeper. Efficiency of labor means the productive capacity of a worker. It indicates the ability of the worker to do more work, to better work during a given period of time. Factors influencing the efficiency of labor. The ability and willingness of the workers to work and learn skills depends upon their health and therefore on the wage rate and the standard of living. The improvement in standard of living leads to an improvement in health through better nourishment. Also, on the average age of the laborer. Literacy is perhaps the first priority to improve the efficiency of labor. Adequate provisions for imparting training to the workers will improve the efficiency of labor. Climatic differences affect production as well. The hot and humid climate is a factor which prevents people from doing more work and thus the ability to display high efficiency. A healthy work environment increases the level of efficiency. The facilities available at the workplace determine the labor efficiency to a great extent. Value and importance indicates with growth in productivity, an economy is able to produce and consume increasingly more goods and services for the same amount of work. Productivity leads to competitiveness and potentially competitive advantages. Value and importance. Increases in output can only be due to increases in the inputs to the production process or to the efficiency with which they are used. Increases in input impose costs on society. Increasing labor means having less leisure time. Increasing investment in capital means lowering current consumption, and increasing material inputs reduce reserves of natural resources. Productivity growth is our opportunity to increase output without increasing inputs and incurring these costs. Productivity increases have enabled the U.S. business sector as much as and as well as many other business sectors around the Caribbean to produce 9 times more goods and services since 1947, with a relatively small increase in hours worked. Productivity and a firm. Productivity growth is important to a firm because more real income means the firm can meet its obligations to customers, suppliers, workers, shareholders, and governments in relation to taxes and regulation, and still remain competitive or even improve its competitiveness in the marketplace. Productivity is one of the main concerns of business management and engineering. Practically all companies have established procedures for collecting, analyzing, and reporting productivity data. The accounting department typically has the overall responsibility of collecting, organizing, and storing data generated by various departments. Key takeaways. Productivity is a measure of efficiency of production. It is a ratio of actual output, that is production, to what is required to produce it, that is inputs. Productivity is measured as a total output per one unit of a total input. Control managers in a given organization are concerned with maximizing productivity through process-oriented observations and improvements. For businesses, productivity growth is important because providing more goods and services to consumers translates to higher profits. As productivity increases, an organization can turn resources into revenues, paying stakeholders and retaining cash flows for future growth and expansion. Factors affecting supply. Supply refers to the quantity of a good that the producer plans to sell in the market. Supply will be determined by factors such as price, the number of suppliers, the state of technology, government subsidies, weather conditions, and availability of workers to produce the required good. Now, let us turn our attention to the chart before us. Movement along the supply curve. Let us analyze this chart. On the lateral plane, we have the quantity stipulated. On the vertical plane, we see the price. As price increases, firms have an incentive to supply more because they get extra revenue, that is income, from selling the goods. If price changes, as is seen from $80 to $116, there is a movement along the supply curve. Example, a higher price causes a higher amount to be supplied, and that is seen in quantity from 60 to 70, an increase by 10. An increase in the price from $80 to $116 causes an increase in quantity supplied from 60 to 70. In our second chart, let's analyze the shift in the supply curve. This occurs when firms supply more goods, even at the same price. Example, more of a specific good is said to have been produced for the same cost. This is summarized using price that is constant. And as we can see on the chart, quantity has moved from level 1 to level 2, which indicates that quantity has increased for the same price. Therefore, the supply curve has shifted from supply 1 to supply 2. Factors affecting the supply curve. A decrease in cost of production. Business can supply more at each price. Lower costs could be due to lower wages, lower raw material costs as well. More firms. An increase in the number of producers increases supply. Investment in capacity. Expansion in the capacity of existing firms, for example, building a new factory. The profitability of alternative products. If a farmer sees the price of biofuels increase, he may switch to growing crops for biofuel on all his fields, and this will lead to a fall in the supply of food such as wheat. Related supply. If there is an increase in the supply of beef from cows, then there will also be an increase in the supply of leather. Weather. Climate conditions are very important for agricultural products, contributing to its growth and/or shortages. Productivity of workers. If workers become more motivated and work hard, then there will be significant increase in output and supply. Technological improvements. Improvements in technology, for example, computers or automation, reduces firm costs. Lower taxes. Lower direct taxes such as tobacco tax or VAT reduces the cost of goods. Government subsidies. Increase in government subsidies will also reduce the cost of goods. For example, train subsidies reduce the price of train tickets. Objectives of firms. If firms are profit maximizers and scheme with other firms, we may see a fall in supply as they try to maximize profits. However, if they switch to targeting sales or revenue maximization, then we will see an increase in supply. Let us turn our attention to the supply curve before you. We will be examining the shift in supply to the left, meaning an upward shift. In this case, there is a fall in supply. The supply curve shifts to the left or shifts up. This causes a higher price. The supply can shift to the left because 1. Fewer firms in the market. 2. Bad weather, resulting in agricultural shortages. 3. Higher taxes. And 4. Decline in productivity, among other things. Here we can see that the supply at S1 has shifted to the left, resulting now in the supply of S2. What does this mean? It means that the quantity produced has reduced, moving to the left from Q1 to Q2. However, price has increased, moving from P1 to P2. Factors that causes a shift in supply to the right. Here we will be examining the shift in the supply curve to the right, meaning a shift downwards. 1. More firms are introduced to the market. 2. There is increased or improved technology. 3. Lower taxes. 4. Higher government subsidies. And 5. More firms entering the market. Let us further examine the supply curve and the shift to the right. Here we can see that quantity 1 has increased to quantity 2, which means that there is a higher production of goods supplied. Here the curve has shifted from S1 to S2, or what we call a shift to the right or a shift downwards. Price has also decreased, meaning price at 1 has decreased to price at 2. Question. 4 factors that affect supply are the number of sellers in the market, the level of technology used in a goods production, 3. The prices of inputs used to produce a good, and 4. The amount of government regulation. True or false? If you said true, then you are correct. Here is why. These relate to the direct changes in non-price factors that will cause an entire supply curve to shift, increasing or decreasing market supply. Now that we've come to the end of today's lesson, I thank you for paying up attention. In our next lesson, we will focus our attention on and explain the importance of productivity in relation to the human resource development. My name is Ms. Bamfield, and thank you for having me.